Do you ever wonder why some traders are consistently profitable and others aren't using trend lines? The difference between the two is how each one uses the trend lines or utilizes the trend lines. Hi traders, welcome to my channel. I am Tori Trades and I have been trading the markets for over a decade now. I'm here to share valuable insights to help elevate your trading. So in this deep dive masterclass, we're going to be going over understanding trend lines, what they are and why they're indispensable, drawing accurate trend lines step by step, and then the strategy, how to implement these trend lines to ultimately make decisions in the market. I'm also going to show real-world examples, real-time examples with real trades and real-time market data, and even some advanced tips. So if you don't already know, trend lines are the foundation of technical analysis. They represent the direction and speed of a specific instrument, and they ultimately help traders identify trends and possible reversals. So what types of trend lines do we have? We have two types of trend lines. We've got an upward trend line, which connects higher lows, indicating bullish movement, and we've got a downward trend line which connects lower highs and signals bearish movement. Bullish trend lines, bearish trend lines, upward trend lines, downward trend lines. Now, how do we draw accurate trend lines? This is the fun part. So let's get into actually drawing these trend lines and how I utilize them. You have to start with a time frame. Now, what does that mean? You could be a day trader, swing trader, a long-term investor. How do the time frames come into play when drawing our lines? And the next thing is reliable tools. What tools are we going to be using to draw these trend lines? I'm going to be using a platform such as TradingView, and I'll be using the drawing tool to help me draw these trend lines. Now let's get into some actual chart time. Here we go. All right, we are opening up TradingView. I've got a naked chart on the screen right here in front of your eyes. I'm going to show you guys how I mark up my charts, how I use time frames, and the tools and which highs and lows I use to utilize my trend lines and how I draw them. I'm going to start by prefacing, anytime I mark up my chart with a completely new instrument, I will always do a top-down analysis. I am always going to start on the highest time frame that I possibly can. So right now we are looking at the YM. This is actually the MYM. This is the Micro E-mini Dow Jones. This is a futures instrument, and this is the micro version of the Dow. So if you guys know what the Dow Jones is, it's an index, and through the futures market you are able to trade the indexes here, or the indices. All right, so we're going to start in the monthly time frame. So we're going to hit the M up here in the top left. And now when drawing my trend lines, the reason I go to the higher time frame is because I want an overall view. I want to know overall from the far left to the far right, the hard right edge where the price is trading at right now. I want to know overall which way is this trending. And I want to go ahead and mark up my chart as well. So we're going to start from the beginning, marking up our very first trend line. Now, ironically, you would think I would use the trend line tool in TradingView, but I actually don't because the trend line tool in TradingView gives a point A and point B and it stops. I want a point A and a point B, and then I want the line to go indefinitely in one direction. So I actually use the Ray tool when drawing my trend lines. All right, when drawing our very first upward trend line on a chart, we're looking for the lowest point we see on the screen. That's point A. Point B is going to be a higher low where the price has not yet intersected and the most recent higher low. So let me see if I can help you guys understand this. We're not going to use this higher low here because price has already crossed the line. It's already intersected. So I like to visualize this line as though it's truly holding the price up. Now here would be pretty accurate, but I like to take this point B and drag it to the most recent touch point, which would be right here back in October 2nd, 2023. So now we have our very first upward trend line. Point A, point B, point C, 3 touch points. But when using the Ray tool, it only gives us 2 points to adjust. All right, we have drawn our very first upward trend line. Now, this isn't the end. So we have just simply drawn one trend line on the monthly time frame. We need to continue doing our top-down analysis. So that means we need to work our way down to the lower time frames. So we're at the monthly. Let's go down to the weekly. And essentially what I'm trying to do is modify my lines to make sure they're a little bit more accurate. As you can see, it's a little bit off now, so I need to adjust it to this new low. And then what I'm doing is I am capturing as much of the movement of the price as I possibly can. So I'm going to continue to connect these trend lines, and it will start to look like a fan of trend lines. Each new line will use the previous point B as its new point A. And let me show you what I mean. So I'm going to continue to mark up my charts and draw steeper trend lines. I'm now in the weekly time frame. I'm going to go back to that Ray tool. And now my point A is going to be my previous point B, that previous recent touch point. Boom. And now same scenario. I'm looking for the next low, the next most recent low. Now you'd think it would be here, but there's an even more recent low over here. So I'm going to take this point B and boop, move it right here. So now we've got yet another 1, 2, 3 touch point upward trend line, same as the last one that we drew in the monthly time frame, but now we're in the weekly. And now we have truly capitalized or identified as much movement as possible. So we've got one trend line and we've got another trend line here. We are truly following the price in this direction that it's going in. We're utilizing all of the movement here. All right, we're in the weekly. We got to continue to go down. We're going to go to the daily. Now, there's going to be some instances where you move down in time frame and there's not anything different you can do. There's no other trend lines that you can draw, so you'll continue to simply move down time frames. So we're in the weekly. Let's move down to the daily. All right, in the daily time frame, same scenario here. We're going to use our previous point B, which was right here, as our new point A. And then we're looking for the next most recent low. Boop. Right here, without price intersecting. All right, we're at the daily. Let's go to the 4-hour time frame. Now, as far as our upward trend lines go, we cannot come in any steeper. This is an instance where there isn't a change or there isn't a difference. There's nowhere we can draw an additional trend line from the daily to the 4-hour. But what I can see is now we can finally draw our very first downward trend line. So we've got our upward trend lines, but now we need to find our downward trend lines. When drawing downward trend lines, it's the same concept that we used for the upwards, but opposite. So for the downward trend lines, we're looking for the highest point we see on the chart. The highest point I see on the chart is going to be right here at 45,224-ish. So that's going to be your point A. Now point B is going to be a lower high, a recent lower high where price has not yet intersected. That's as far as we can go with the downward trend lines. But I can see a steeper downward trend line that I can draw right here in the 4-hour time frame without having to go down to the 1 hour yet. So I'm going to come in with another trend line. New point A is always going to be previous point B. All right, beautiful touch points here. Now in the 4-hour time frame, that's as far as I can go. But now I can go down to the 1 hour time frame. This is where we're going to stay. How do you know what time frame you stay in or which time frame you stop in? And that's going to be which time frame you have committed to or decided to trade in. I don't jump time frames. I don't go from lower back to higher looking for sooner entries. I commit to one time frame and look for my entries and exits in that specific time frame. But when marking up my charts for the first time, I will always do this top-down analysis. So that's how I know I'm going to stop in the 1 hour time frame. But I do see some adjustments I can make to my lines, and I can see a steeper trend line that I can draw. So we're going to continue to use our previous point B as new point A, and here we go. This is a lower high right here. Now I can even come in a little bit steeper. Previous point B, new point A, and here we go. All right, if the price of the YM can continue down right here, this will be a 3 touch point trend line right here. Now, we've done all of our analysis. We've done all of our chart markups from top down, from the monthly to the weekly to the daily to the 4 hour, all the way down to the 1 hour time frame where I'm going to make my trading decisions. So I have demonstrated how to mark up your charts and how to accurately draw your trend lines. Next, how do we incorporate these trend lines into our trading strategy? And how can they provide clarity and confidence? We're going to go over 2 different types of examples when trading trend lines. There are 2 options. We can trade a breakout strategy or a bounce strategy, or a combination of the 2. So when incorporating the bounce strategy, when price gets to one of our trend lines, we're anticipating that the price is going to bounce off of that trend line, suggesting that this is going to be a trend continuation. And I'll give you an example in just a moment. And then the breakout strategy, which is my all-time favorite. This is when price breaks through a trend line, indicating a potential trend reversal. Okay, so let's go over the concept of trading the bounce of a trend line. So right here where the price is at now of the YM, we're going to go ahead and take a short position, anticipating that this is going to be a trend continuation, that this is simply just going to be yet another touch point to this downward trend, and it's going to continue down. So this is where we would place a sell order. We're in a short position now. Now, how do we mitigate our risk? So we are currently in a short position, anticipating that the price of the Dow is going to continue down and just simply bounce off of this trend line. There's going to be many ways of mitigating risk, understanding the capital that you have to trade, the capital that you have in your account, and how much percentage in conjunction to the capital should you be risking. A great rule of thumb, especially for beginners, is going to be anywhere between 1% and 2% of your capital. Now, let's say you have an account size of $128,000. That means we could risk anywhere between $100 to $2,500 in this specific trade. So now that's a good rule of thumb to know, okay, if this trade doesn't work out, we're willing to risk $1,000 to $2,500. But now let's see if we actually need to risk that much in this specific setup. So where do we put our stop loss? Our stop loss is going to go on the other side of our downward trend line. So if the price doesn't bounce off of this downward trend line, we know, okay, time to close this trade, time to take a loss. Now in this scenario, we only need to risk $50. If the price comes up to $43,719, we know, all right, this wasn't a bounce of the downward trend line. I'm willing to lose $50 on this trade. So we have our stop loss in place. If the price comes up, breaks this downward trend line, and hits this $43,719, we have just taken a $51 loss. But now what happens if the price continues in our favor? The coolest part about this strategy is we don't have a take profit set. Now you're more than welcome to add one and to have one. If you don't want to hold this trade for that long, if you're simply just looking to get a quick buck or build that confidence or just rack up those small wins, absolutely use a take profit. And a good rule of thumb for take profits is always to use an area of support or resistance where the price is likely to hit and turn around multiple times. So putting our take profit at 43,434 is an ideal take profit since the likelihood of the price getting back to this area, which it's done in the past, and then turning around is very high. We could simply add a take profit here, making $91 for this trade. Or my favorite way to do it is allow the trend to play out. Allow the trend to move. If the price of the Dow continues in our favor, which I'll do a little path tool just to give you an idea. If it continues down, pulls up a little bit, comes up, comes down, continues along this downward trend line, we're able to take our stop loss and trail it into profit. So it's no longer at that negative $51. Now we trail it and we move it along that trend line. But as soon as price breaks the downward trend line that we're anticipating it to follow, then we know it's time to take that profit. So now let's say that price does finally break. That means we would have been able to move our stop all the way down to 43,358, knocking us out of our trade with a profit of $129. So just think of it like manually moving your stop into profit as price progresses, as price moves in your favor along that trend line, and then you simply just wait for the price to break out of that trend line and take your profits. Or if the trade doesn't work out, you'll know pretty quickly, especially when trading the bounce, by putting that stop on the other side of your trend line where we originally had it here at this 43,719. Now let's go over another scenario, the breakout method. So we're going to close this trade here and go over a second scenario. Since we don't have a breakout of price in this example, I'm going to draw an example with the path tool. So let's say that the price of the YM continues down and breaks this upward trend line. Using the breakout strategy with trend lines, we enter when price breaks a trend line instead of bouncing. So we are anticipating that this is going to be a trend reversal. So a reversal of this upward trend line. Now this upward trend line was drawn in a higher time frame, so it holds a little bit more weight. So we're thinking that this higher time frame upward trend is about to get a reversal, and we're going to be continuing down on this new trend here. So let's say that we consider taking a short position here. We would think short positions because price broke instead of thinking short positions because price bounced. So we're thinking short positions right here at 43,417. There we go. We've got our short position right here. Now, how do we mitigate the risk? It's going to be the same exact scenario that we mitigated our risk using the bounce, but what's different about this strategy is our entries are based on different reasons. So instead of anticipating a bounce, we are anticipating a trend reversal. So we're still thinking short positions right here at this 43,413-ish. And now where does our stop go? We're going to put as though if the price was to come up and break our downward trend line, we would put our stop somewhere around this 43,592. If the price was to come up and break, we would think, okay, close me out, take my loss at, it's probably going to be around, if this is the same scenario, it'd probably be still around that $50. And this is going to be same scenario. So we're going to continue to stay in this trade as long as the price continues along this downward trend line. So same exact scenario for the exits. You're going to trail that stop. If price progresses in your favor, you get to move that stop into profit. If the price doesn't work out and breaks this downward trend line, then we take our $50 loss. Now we can increase position size. I just used one contract as an example before, but since this account size on the paper trade is 128,000, we could risk anywhere between $1,000 and $2,500 for each trade here. That 1 to 2%. Or, especially for the newbies and the beginners, just experimenting with one micro is an excellent place to start, especially in the futures market. Now, the exit criteria is exactly the same as the bounce. As long as the price continues along this trend line, we're happy. We're making money. We get to move that stop into profit. If it doesn't work out, we took that $51 loss, and then we're on to the next trade. Now let's go over a real world scenario where I used this method on a live account. So we have our upward trend line here. We've got 1, 2, 3 touch points. The price broke out of it. That was my indication to take a short position since price broke out of the upward trend line. And then what kept me in? Where did my stop loss go? Stop loss went on the other side of the downward trend line. So I was willing to risk $8,900 if the price, as soon as I got in, broke the downward trend line. And then how long do I stay in for? So remember that scenario where I said, if you're looking to close profits, to take those small wins, or you're not looking to hold that trade for as long as possible, you want to look for an area of support or resistance as a take profit. So we have our entry based on the break of a downward trend line. And then the price got to an area of support where it's very likely that the price of crude oil here was to hit and turn around, hit and turn around. It hit and turned around here. So I closed my trade here at this 72.26-ish area and made a profit of 27,683. I had a 3.11 R here, and this is a real example of an actual trade that I placed using the breakout strategy. So here's a few advanced tips for you traders already utilizing trend lines. When you've done your top-down analysis and you've marked up your charts and placed all your trend lines, as price progresses, price will intersect and cross through those original trend lines. So you're going to have to adjust your trend lines on a regular basis to adapt to the market. That means utilizing new point A's and new point B's, steeper trend lines, or adjusting the trend lines